Lending is an important activity in the capital markets. For example, lending allows individuals to purchase homes and cars, and businesses to invest in inventory and facilities. Banks, credit unions, and other institutions that lend to individuals and organizations know that when underwriting loans, a certain percentage of the loans will not be collected. These institutions must estimate credit losses in order to reflect the amount they expect to collect on the loans. In June 2016, the Financial Accounting Standards Board, or FASB, issued a new standard that improves how credit losses on financial assets are communicated to investors and other users of financial reports.
In October of 2008, the FASB and the International Accounting Standards Board established a Financial Crisis Advisory Group, or FCAG, to advise the boards on improvements to financial reporting in response to the financial crisis. The FCAG identified delayed recognition of credit losses as a weakness in current GAAP. Consistent with what we'd heard from other stakeholders, FCAG recommended the boards explore more forward-looking alternatives to today's incurred loss methodology.
During this time period, stakeholders were frustrated. Bankers because accounting rules restricted their ability to book more reserves, and investors because they had to develop their own expected loss estimates based on less reliable external proxies. In the 4 years leading up to the crisis, loans held by banks in the U.S. increased 45%, while reserves set aside for losses decreased 10%. A commonly used metric, percentage of loan loss reserves to loans, was at a multi-decades low just months before the crisis.
The board developed various proposals to address these issues. The FASB issued 2 documents separately from the IASB, and 1 document jointly with the IASB. A 2010 exposure draft, a 2011 joint supplementary document with the IASB, and a revised 2012 exposure draft.
The FASB engaged in extensive outreach with stakeholders when developing the credit losses standard. As part of the process, the board considered more than 3,300 comment letters. The board also participated in a number of outreach activities. These included more than 85 meetings and workshops with preparers, meetings with more than 200 users of financial statements, more than 10 roundtables with more than 100 representatives, and 25 fieldwork meetings with preparers from large and small financial and non-financial institutions.
Based on this feedback, the FASB developed its current expected credit loss, or CECL, model that's central to the new standard. The new standard requires an organization to measure all expected credit losses for financial assets held at the reporting date based on historical experience, current conditions, and reasonable and supportable forecast, and provides those organizations with the opportunity to look forward and measure their own portfolios at the amount they expect to collect, which will result in timely and relevant information that better meets the needs of investors.
In communicating with stakeholders throughout our due process, we were able to improve the final standard. For example, stakeholders expressed concern that more losses would be recognized under the CECL model. In fact, CECL does not change the amount of the loss recognized on a loan. It simply affects when the loss is recognized. It just changes the timing. The new standard still will require judgment to be applied in determining credit loss estimates. It will not prescribe the methodology to be used. That's up to the financial institution.
The board listened to stakeholders of all sizes and developed a model that does not require costly or complex modeling. It provides discretion for preparers to determine a method that is appropriate to them based on the credit risk in their portfolio and their systems and processes.
Under the new standard, key information about the credit quality of a loan portfolio will be provided through qualitative and quantitative disclosures. This will increase transparency over the credit trends in the loan portfolios, and that's a big win for investors.
Investors will have the information they need. They'll no longer have to make their own estimates about expected credit losses.
The new standard focuses on the economics of financial assets and no longer relies on triggers or accounting thresholds for recognition.
In summary, this standard aligns the accounting with the economics of underwriting and the informational needs of investors. And we've taken a trust but verify approach to disclosures.